picture this. It's like 2 a.m. on a Tuesday.
Oh, never a good time for a phone call.
Right. Never. A main pipe just burst on the fourth floor of a commercial building, and thousands of gallons of water are currently just tearing through the drywall.
Wow.
Yeah, completely flooding the corridors below, threatening the structural integrity of the whole property. Now, for the property manager whose phone is ringing off the hook, this is an absolute heart-pounding nightmare.
Oh, definitely a total disaster.
But, and this is the crazy part, for a certain type of strategic business owner, that exact chaos is the foundation of a highly predictable, incredibly resilient wealth strategy.
Which is such a fascinating flip in perspective, you know?
How they is.
You're taking this moment of pure unpredictable panic and, well, you're applying a highly structured, scalable business system right over the top of it.
And that is exactly the core of what we are getting into today. Welcome to the deep dive. Today we are opening up the franchise documents, the financial outlines, and the operational blueprints of a rapidly scaling brand in the disaster restoration space.
A company called All Dry Servicers.
Exactly. All Dry Services. We're doing this because, look, whether you're a corporate professional sitting in traffic right now, quietly plotting your escape from the 9-to-5 grind.
We've all been there.
Right. Or maybe you're an existing franchise owner looking to expand your portfolio.
Yeah.
Either way, you're probably wrestling with one massive question. In an economy that feels completely unpredictable, what kind of business model is actually truly resilient?
That's the million-dollar question.
Literally.
Yeah.
So our mission for this deep dive is to get under the hood of this operation. We want to unpack the buyer psychology, the service delivery, and the unit economics. We want to help you figure out if this is the right vehicle for your own wealth creation.
I love it. Let's get into it.
But, okay, before we get into the operational nuts and bolts, I really have to push back on the fundamental premise here.
Oh, okay, let's hear it.
So when people dream of leaving their corporate job for business ownership, they usually have this incredibly romanticized vision.
Oh, for sure. The dream.
Yeah. They think of opening, like, a beautifully lit artisan coffee shop.
Or a high-end fitness studio.
Exactly. Or maybe a boutique bakery. They want something visually appealing. They do not usually daydream about sewage cleanup, mold remediation, and storm damage.
Not exactly glamorous dinner party conversation.
Right. So why are savvy, serious investors flocking to this extremely, unsexy emergency restoration industry?
It's a great question. The contrast between the fantasy of business ownership and the actual reality of wealth building is massive. You're right, disaster cleanup completely lacks the glamour of a boutique bakery.
Completely.
But let's look at the underlying mechanics of consumer behavior. A high-end bakery or, a boutique fitness studio, those rely heavily on discretionary income.
People have to want to spend money there.
Exactly. They're fantastic businesses, but they depend on a consumer actively choosing to part with their disposable cash. Disaster restoration, on the other hand, is entirely need-based.
Because it's driven by emergencies.
Right. Unavoidable life emergencies. If a storm tears the roof off your commercial building or a pipe bursts in your basement, you are not casually checking your monthly budget to see if you can, afford to mitigate the water damage.
No, you're panicking and trying to stop the bleeding.
You simply have to fix it immediately.
Because if you don't, the asset is destroyed.
Precisely. And that dynamic shifts the entire business model from hoping consumers choose to spend money with you to providing a critical, unavoidable service that protects their largest assets.
Which changes everything about the sales pitch.
It does. That's why serious investors view this not as an unsexy business, but as a highly strategic play. You're servicing a necessity, not a luxury.
Okay, that makes a lot of sense. So let's unpack how that actually works in practice. Because before we look at the financial requirements and what it takes to actually buy into this franchise, we first need to understand the service delivery model.
Right, the actual operations.
Yeah. How does a company like All Dry actually differentiate itself in the home services market?
From what we're looking at, their service list is incredibly comprehensive.
It really is.
They handle water damage, leak detection, flood damage, mold removal, and fire and smoke damage. And then they get into the really specialized heavy-duty operations.
Right, the intense stuff.
Yeah, like storm damage, sewage cleanup, odor removal, biohazards, and even trauma scene cleanup.
And importantly, they are providing these services for both residential homes and commercial properties.
Which are two very different beasts.
Completely different operational motions. But to really understand their differentiation, You kind of have to look at the timeline of the brand. They were founded back in 2014, but they didn't actually start franchising until 2020.
Wait, so they spent 6 years operating before letting anyone else buy in?
Right. They spent 6 full years ironing out the operational kinks in their own corporate locations.
Yeah. In the franchise world, that is a lifetime of trial and error. They were building out the standard operating procedures, refining the equipment lists, and perfecting the software systems on their own dime.
Before they ever asked a franchise to risk their capital.
Exactly. And the proof of that foundation is in the growth rate. Since 2020, they have scaled to 126 units nationwide.
That is massive growth in just a few years.
You simply don't hit that kind of footprint in such a short time without a highly replicable, deeply tested system.
I want to dig into that system, actually, because the guarantees built into it are pretty intense.
Oh, they are?
They promise a 1-hour response time. They're available 24/7. They offer a 100% satisfaction guarantee. Their personnel always arrive in uniform. And this is the big one, they absolutely never use subcontractors.
That's the kicker.
But hold on, guaranteeing a 1-hour response time around the clock with 0 subcontractors. That sounds like a payroll and logistical nightmare.
It sounds impossible, right?
Yeah. How do you actually guarantee a guy in a uniform is ready to go at 3 in the morning without just bleeding money on overtime?
Well, it is a massive logistical challenge, but it's also their ultimate competitive moat. Building a logistics network that can respond within an hour requires intense operational discipline and highly structured on-call scheduling.
Okay.
But let's look at why they refuse to use subcontractors, because that's really the secret sauce here. In the broader home services industry, outsourcing overflow work to third-party subcontractors is, well, it's incredibly common.
Sure, because it saves the primary company money on payroll and benefits.
Right. But the trade-off is control.
A total loss of control.
Exactly. When you subcontract, you lose your grip on the customer experience. You do not know if the person showing up to the customer's flooded house is going to be professional, empathetic, properly trained on the equipment, or even wearing a clean shirt.
And remember the context here, right? The customer is in the middle of an absolute crisis.
Exactly. They are panicking. By insisting on 0 subcontractors and utilizing only highly trained, uniformed in-house employees, AllDry is basically professionalizing the emergency.
I like that phrasing, professionalizing the emergency.
They are bringing calm, structured expertise to a chaotic situation.
Which is invaluable. I mean, when my kitchen is under 3 inches of water and my stress levels are maxed out, I really don't want a random guy in an unmarked van pulling up.
No one does.
I want a professional team that looks like they have done this 1,000 times.
And for the franchise investor, especially the semi-absentee investor, that lockdown operational protocol is everything.
How so?
It means the brand standards are mechanically upheld. The business can run efficiently without the owner needing to be the one, putting on boots and swinging a hammer in the middle of the night.
Right, they aren't the ones doing the actual cleanup.
The proven system manages the emergency. The owner's job is to manage the system.
Okay, let's shift gears and talk about how that system actually makes money. We understand what the business does and how they maintain quality control, but now we really need to examine who actually pays for it.
Following the money.
Yeah. Moving from operations to revenue generation. How does an AllDry franchise actually acquire customers? Because handling the physical cleanup of a flooded basement is one thing, but dealing with the financial fallout of property damage, that's a totally different headache for the consumer.
Oh, that is usually the biggest pain point for the property owner. The physical damage is only half the nightmare.
Right. The other half is the administrative mountain of fighting with your insurance provider to get the work actually covered.
Exactly. And AllDry positions itself to completely manage that entire friction point. They do not just hand the homeowner a massive bill and say, hey, good luck with State Farm.
Thank goodness.
They work and manage the claims directly with the customer's insurance provider.
Wait, how does that actually work mechanically? Are they functioning as, like, insurance adjusters?
Not exactly, but they use the exact same language and systems. The franchise utilizes industry-standard estimating software that formats the scope of work and the pricing exactly how the insurance companies need to see it.
Oh, clever.
By speaking the insurance company's language, they totally streamline the approval process. They're essentially restoring the homeowner's peace of mind by taking this massive administrative burden right off their plate.
So the homeowner just signs off on it.
Pretty much. The homeowner signs an authorization, and the franchise handles all the heavy lifting with the carrier. That is a monumental selling point for direct-to-consumer residential jobs.
I can imagine. But relying purely on residential emergencies seems really unpredictable.
It is.
If I own a territory, what does my day-to-day actually look like? Am I just sitting in a leased office, staring at the phone, waiting for a localized rainstorm or a random pipe to burst so I can deploy my trucks?
If you are just waiting for the phone to ring with residential emergencies, you are running a purely reactive business.
Right.
And while those one-off residential emergencies provide fantastic margins, it makes revenue forecasting incredibly difficult. You literally cannot predict when a specific homeowner will have a kitchen fire.
So how do you forecast?
This brings us to the real growth engine of the model. It's the business-to-business, or B2B, strategy. This is how the franchise owner takes control of their pipeline.
Break that down for me. How does a disaster cleanup company shift from being reactive to proactive?
By understanding the statistical law of averages in commercial real estate, a savvy franchise owner focuses their energy on networking with the professionals who deal with property damage at scale.
Okay, so who are we talking about here?
We're talking about local insurance agents, claims adjusters, apartment and condo property managers, and real estate investment trusts, or REITs.
Ah, the people who manage huge portfolios.
Exactly. Think about the math here. If a property management firm oversees 5,000 apartment units in your city, it is a statistical certainty that a certain percentage of those units will experience water damage, fires, or mold every single month.
Right, with 5,000 units, it's not an if, it's a when.
Precisely. It's guaranteed volume.
So the goal is to get in front of those property managers before the damage actually happens.
Exactly. You secure the relationship in peacetime.
Peacetime, I like that.
Yeah. You take the property manager to lunch. You show them your pristine trucks, you explain your 1-hour response guarantee, and, crucially, your zero subcontractor policy. You become their preferred vendor.
So when a massive storm rolls through and damages 15 properties managed by that same firm,
that manager isn't frantically searching Google for a mitigation company. They're calling the trusted vendor they already have on speed dial.
they're calling the structured, reliable system.
Exactly. And that transforms the franchise from a reactive emergency service into a proactive relationship sales business.
That's a huge mindset shift.
Building these B2B relationships creates a pipeline of recurring, predictable volume. For the franchise owner, the primary day-to-day role shifts away from managing the technical cleanup and moves entirely toward high-level business development.
You're managing relationships, securing vendor contracts.
And driving the enterprise forward. That is the true multi-unit growth strategy.
Okay, that makes complete sense.
Mm-hmm.
We've established the strong market demand, the necessity of the service, and how the B2B revenue streams create predictability.
Yep.
Now let's connect this to the actual numbers. What is the financial reality of setting up this system? Looking at the requirements, the initial investment range is anywhere between $87,749 up to $275,300.
And to formally qualify to purchase the franchise, the brand requires a candidate to have a minimum net worth of $250,000.
Okay.
And a liquid cash requirement of $175,000.
Let me stop you there because I really have to look at this critically.
Sure.
Compared to opening a massive retail location, say a big boutique fitness studio, or a quick service restaurant where you have millions of dollars in commercial build-out costs.
Mm-hmm.
Heavy real estate leases, massive equipment.
Oh, yeah, those are huge.
Right. So an entry point starting under $90,000 seems incredibly low. But isn't a low barrier to entry a massive red flag? Doesn't that just mean the market is totally flooded with anyone who can scrape together a small loan?
That's a very fair concern.
Like, how is this not just a race to the bottom in terms of quality?
That is exactly the question a savvy investor should be asking, but you have to look closely at how those financial requirements are structured.
Okay, how so?
The absolute minimum physical investment to get the doors open might technically be around $87,000, but notice that the liquid cash requirement is significantly higher. It's at $175,000.
Right. Why the big gap? Why do I need $175,000 in cash if the business only costs $87,000 to start?
Working capital. The franchisor understands that to dominate a territory, you need way more than just a truck and some fans.
You need a runway.
Exactly. They want to ensure you have ample capital reserves to survive that crucial launch phase. You need cash to aggressively fund your local marketing, pay your in-house technicians while you're waiting on those insurance payouts, and heavily fund your B2B networking efforts before the cash flow stabilizes.
Ah, so it is a filter.
Yes, they are intentionally weeding out people who are undercapitalized. They don't just want someone who can afford the initial franchise fee, they require someone who is fully capitalized to execute the business development plan.
That significantly changes the perspective. They're basically protecting the brand by ensuring owners are properly funded.
Exactly.
But, I mean, for the corporate professional looking to make this leap, $175,000 in liquid cash is still a very serious hurdle.
It is a lot of cash.
Most people have their wealth tied up in home equity or retirement accounts.
Hmm.
How are people actually funding this without taking on crippling high-interest commercial debt?
This is where we see a lot of corporate professionals utilizing a financial mechanism called ROBS.
ROBS, like ROBS.
Yes, it stands for Rollovers for Business Startups.
How does that work? Because usually if you touch your 401k before retirement age, the IRS just hits you with massive early withdrawal penalties and taxes.
Which is exactly what the ROBS structure avoids. Without getting completely bogged down in tax law, the basic mechanism works like this. You form a new C corporation for your franchise.
No.
That new C corporation creates its own retirement plan. You then roll your existing 401k funds into that new retirement plan.
Still with you.
Finally, the new retirement plan purchases stock in your new C corporation. The corporation now has the cash to buy the franchise and fund the working capital.
Oh, wow.
And because it was a rollover into a new plan that bought company stock, it is not considered an early distribution.
Wait, so you were essentially investing your retirement funds into your own privately held company, totally tax-free and penalty-free.
Correct. It allows an aspiring owner to unlock their hard-earned retirement savings to fully capitalize the business on day one.
Without taking out a massive bank loan.
Exactly. You don't burden the new business with heavy monthly debt payments. It makes the transition from employee to owner much more strategic and secure.
That is a brilliant piece of leverage. Wow. Let's talk about the ongoing relationship with the brand, though, because buying a franchise obviously means paying royalties.
Right. It's a partnership.
We're looking at a 10-year franchise agreement term, which is renewable. The ongoing fees consist of a 7% royalty fee on gross sales and a 1% ad royalty fee.
Yep. Pretty standard.
7% is a fairly standard slice in the franchise world, sure, but what is the owner actually getting for that ongoing cut? Like, what does the corporate support actually look like here?
Well, you should always measure the royalty percentage against the actual infrastructure provided. You are essentially paying for a shortcut.
Makes sense.
In this case, All Dry maintains a staff of 20 employees at their headquarters. For a franchise system with 126 operating units, a 20-person corporate team is an incredibly strong support ratio.
What are those 20 people actually doing day to day?
They're providing dedicated personnel for national marketing strategies, ongoing operational and technical training, compliance with complex insurance industry standards, and most importantly, B2B sales coaching.
Helping you get those property managers.
Exactly. They are teaching you how to secure those massive property management contracts. You're paying 7% to not have to figure out the marketing or the software integration on your own.
Which saves you years of trial and error.
Right. That corporate infrastructure justifies the partnership. Furthermore, that 10-year renewable term is highly strategic.
10 years gives you a lot of runway to actually build something.
It gives you a solid block of time to build serious equity in the business. You spend the first few years dominating the local B2B landscape, then you scale into multiple territories using the cash flow you've generated.
And then?
Eventually, you can structure a highly profitable exit strategy when you are ready to sell the enterprise. You aren't just buying a job. You are building a scalable asset with a very clear horizon.
So bringing this all together, what we're really analyzing here is a business model that trades the superficial glamour of consumer retail for the rock-solid stability of an essential service.
Perfectly said.
All Dry Services basically represents a highly structured, remarkably resilient opportunity. It takes the absolute certainty of unavoidable life events, the storms, the broken pipes, the accidents, and leverages them into a scalable enterprise.
Yes.
And it achieves this through aggressive B2B networking, highly professionalized service delivery that maintains strict quality control by flat-out refusing subcontractors.
Which we discussed is huge.
Right. And unit economics that are strategically accessible for the corporate professional who knows how to leverage their capital,
Yeah.
like with the ROBS program.
It fundamentally redefines what a desirable business looks like.
It really does.
The shift in mindset is profound. It's about moving your perspective away from what looks good on a trendy street corner and focusing entirely on what looks bulletproof on a balance sheet.